Okay, welcome back to the next session here. I'm still finishing up a discussion of externalities, and if you remember when I finished up last time, I talked about externalities being, generally speaking, with regard to the government and the government's actions and activities, a cost of production that's not being reflected in the price. And the example that I gave was of pollution. That's the easiest example to describe, and therefore governments try to do something about pollution because it has costs to society that ought not be being borne. And so we try to minimize pollution at the source. Now, I'm gonna switch over here to the document camera, and I'm gonna describe what happens with an externality. Let me get a different pen here. So I'm gonna put up our old supply-demand curve here, and I've got my curve here, and then I've got some kind of demand for a commodity, and I've got a supply for a commodity. So I have my demand curve, and I have my supply curve are right here, and then this is in a apparent equilibrium. We have some commodity. I'm buying something from this factory, and so I'm paying for it at price there, and this commodity down here, this quantity, excuse me, is being produced. So here I am. Everything's all hunky-dory. We're happy, and the market is apparently Pareto optimal, and it's efficient, and we're just doing what we're doing in the market. But we find out that this company has been inappropriately shifting costs. Let's say that this company has been illegally dumping some of the results of its production processes onto the land or into the water. And therefore it's escaping pre-treatment costs that it should have spent, or categorizing, for example, the byproduct as a hazardous waste that must be disposed of properly, for which they would have to pay for specialized hazardous waste disposal services. So because they're not paying for that, because they're dumping or they're emitting an externality, an external cost of production that they should be bearing, we're paying for it. Now, let's say, though, that they have to be made to pay for they have to be made. Well, what happens when they have to be made to pay for it at this level of production, given this level, and let's assume this is for all of the industries who make this thing. We have an optimal level of producers Q, and we have an optimal price that's being paid for this P. Everything is all happy. But now what happens is, because the producers have to absorb or not internalize the full costs of production, the supply curve shifts. And what the supply curve does is it moves over. Let's say the supply curve moves over here. It moves over here. Demand hasn't changed. We still like whatever we had at the price. We haven't changed at all. What's changed is the cost of production for this firm, because this firm is being made to internalize its external costs. So it's having to install pollution control and monitoring equipment, and it's having to pay for hazardous waste disposal. And maybe because they've been doing it a long time, they're having to pay for cleanup costs associated with the past, and they're having to make everything right. Well, now what happens? Now what happens is the supply curve shifts up and to the left. And because the supply curve has shifted up and to the left, then the quantity that's going to be supplied is only the amount at this price. I'm going to go over to here at this new price, P1. The quantity that's going to be supplied in society at that price is going to be Q1. And so society is going to be it's going to be getting the right signal, and it's going to be paying for the right price for the commodity, and as such, the amount of the commodity demanded will have to go down if the price goes higher. And the only people that can afford to do this are going to be those that were most efficient, the most efficient producers. But what's happening by the time we get to this point is that we are rebalancing the market, and the market is being rebalanced. And what we've done is move the market away from a market failure where externalities were not being realized into a position where the market now is in balance, and the consumers are getting the right kind of signal, paying the right kind of price, and producers are producing the right amount of the product at the right kind of price. And so now, because of what happened, because that externality was now internalized, we've gone from a market failure and a bad situation to a market improvement. So society is better off as a consequence of this. We're worse off in one sense because we don't get as many of these things anymore, because I can't buy them anymore because they're too expensive. But we're better off because the damage or the harm that was done to society in the production of these things has been reduced. And the price that we pay for this has now been reflective of that damage. So that's what an externality does. And it produces this improvement in the market when we address it. It's a market failure and an externality. There are all kinds of externalities, but this is a market failure that we ask to be corrected in the market. Okay. Now I want to move on, and we're going to get to the last market failure. The first one was public goods, of which there were merit goods and pure public goods. Pure public goods were just that general public clean air, clean water, public safety. Then we moved to externalities, the next kind of market failure that I wanted to talk about. And externalities have two types. We really deal with what are real externalities, something that increases consumers' consumption costs or producers' real costs, but they're caused by somebody else, like pollution, something requiring more inputs. So we want to pay attention to externalities. In benefit cost analysis, we concentrate on real externalities. Now, I want to move into the category of a declining cost industry. And there are all kinds of things that are declining cost industries. They are called natural monopolies. And they're called natural monopolies. I'll get to that in a minute. Because society is actually better off if they're allowed to produce. If there's only allowed to be a few or one producer within a geographic territory, actually one producer, that society is better off letting it be a monopoly than to allow competition. And the reason is because these are entities that have extremely high capital costs, and that it's best to have them situated most efficiency so that they're maximizing their service area relative to their startup costs. So in a natural monopoly, consumers continue to realize what we call a consumer surplus or enhancements to their well-being, so long as marginal cost of production equals price. Now I'm going to explain that in a situation. And I want to do it here, and then I'm going to do it in a graph. Imagine something that costs quite a lot to build. Let's say it's a brand new modern electricity plant. And let's imagine that it costs $250 million to build this electricity generating facility and all of the distribution infrastructure. So I've got this thing up, and then now I've filled it up with coal, and I've fired up the boilers, and I'm going to start selling electricity. Well, the first amount of electricity that I'm selling, the first unit of electricity I'm selling, is going to be equal to The very first unit is going to cost $250 million. The average cost of that electricity was $250 million. And as the amount of electricity I sell goes up, as I start moving, as more people use my electricity, more and more people, because my capacity is fixed. I'm going to fire up this generator and make electricity. And what I want to do is sell as much of my capacity as I can. So as my demand goes as far, my quantity demanded goes over closer and closer to the amount of electricity I can produce, then the average cost per unit delivered, of course, goes down. It goes down. Okay? And so I have my capital cost and my operating cost, which is coal and all the other things that it takes, and labor and everything else that it takes to make electricity happen on a daily basis. But my big cost is my plant and equipment. That's my capital cost. So that's what my average cost is. So let's go to a graph and take a look at it. And this may be a little bit hard to discern, but let me do this anyway. I'll get the pointer up here, and I'll get the felt tip pen. Here I have a traditional declining cost type of industry, and I have a demand, D, and I have an average cost right here. I have an average cost curve. So here's what I was talking about. At producing, let's say it was electricity, producing the first unit of electricity, my average cost would be very high. Producing, let's say, at a quarter capacity, I'm selling about a quarter of my electricity, my average cost sold would still be very high. My average cost, over here, read it on the price side, would still be very high. So what I want to do is sell enough of my electricity so that I'm starting to recover my average cost. So we need to figure out at what point am I producing the kind of electricity, the amount of electricity that allows me to cover my average cost. Well, what happens in a declining cost industry is that it only will produce to the point, it'll only supply enough of a commodity to the point where it covers its average costs, where it maximizes its return on its average cost, where it's producing at exactly the level of commodity that gives it a return plus a return to investors and every other thing out, its average cost. But society likes electricity, and this plant can produce a lot more electricity. But it won't produce a lot more of electricity, because if it produces more electricity out here, if it produces electricity out here, out to this level, it can only get this price. And at this price, it's not covering its average costs. Yet, we have something called the marginal cost. And the marginal cost is down here, right here. The marginal cost is a little different. You see, I'm a consumer. I don't really care what your average costs are. What I'm interested in is the marginal cost. What does it cost to produce one more unit of electricity? Well, you already paid for the plant. You already paid for the high-line wires. You don't need to hire any more people to produce electricity. You keep producing electricity at the marginal. You just got to buy more coal and process more water and whatever else. That's all you have to do. I just want to pay for that stuff because you already got that other stuff that you got to deal with. I want to just pay for the price of getting me. So society is better off if we're producing down in the territory of the marginal cost. Society wants to be down here. Society wants to pay this price at this commodity, at Q amount, because we're producing closer to capacity. Society is better off. And the only way for society to get that extra electricity, because the company's not going to produce it, is to put another company up, another electrical company up. But another electrical company would make it so that this company couldn't sell enough electricity to cover its average cost, and it'd have to raise prices. And the other company wouldn't be able to sell enough to cover its average costs, and it would have to raise prices. And in competition, being too close to each other to supply the amount of electricity that's actually needed, they're cost generating as opposed to cost saving. And so society is made better off by allowing a natural monopoly to exist in an area, preventing competition, and then trying to figure out a way to induce that monopoly to continue to produce more of that commodity so that it satisfies this marginal cost curve rather than the average cost curve. And I'm going to flip my pointer back. These things are awful. I can never see them. There we go. I want a visible pointer. And I'm just going to move on. So what are the remedies? Well, a profit-maximizing firm will not increase output to the point where marginal cost equals price equal Q on the quantity supplies, because they would be losing money. They would not, at that level of sales, given the marginal cost curve, be covering their costs, their average costs of production. They'd be making a loss. They may be breaking even on an economic sense, but they would be making no profits. And so who's going to invest in a company that's being made to produce to a level where the profits, not just all profits, are zero? Nobody is going to. So they are losing money if they produce at that level. And so accordingly, they become consciously market inefficient in order to maximize profits. So here's an exception where they have to be inefficient in the market. Society is better off when they're producing more, but they have to be market inefficient to cover their costs. So what's the solution? Well, one of the ways is discriminatory pricing. We allow them to price electricity at a higher cost at times, perhaps when there's peak demand, like during the daytime or early evenings. We can have the government produce the good, the production of this good. The government can just produce electricity because the government doesn't care about profit, and the government can make electricity. It's not that hard. The government can set prices, or it can establish rates, and what it can do is establish rates at a guaranteed level to the firm, basically at a certain level of production that allows the firm to have a trade-off between what it wants to accept as its average costs versus what's more beneficial to society, and the government will allow them to do that. Or the government can subsidize demand, and what it simply does is it provides more demand, more money for people to buy electricity, which sends a signal to the producer to produce more electricity. So those are some of the solutions for dealing with this kind of market inefficiency. Well, we've moved now to this thing called consumer surplus, and a consumer surplus is the desire or satisfaction achieved beyond the actual price of a commodity. Remember back a couple where I colored the area in the traditional supply-demand curve yellow? All of that area is the consumer surplus. And what we want to do with government action, what we want to do is to demonstrate that we are producing an increase in consumer surplus. And that's what we use benefit cost analysis to help us understand. Are we increasing people's well-being by providing more of something that they desire? And we produce an increase in, and I'll draw this in just a second. We produce an increase in consumer surplus from a variety of ways. One are just straightforward efficiency gains. And remember, by regulating efficiencies, by regulating externalities, we made the market more efficient, and now we're trading off the cost of making the market more efficient for the gains that accumulate to society because they're not having to bear those external costs of pollution or water or something else. Consumer surplus is enhanced by producing more or deploying technology much more efficiently and much more effectively. Imagine 50 years ago, 60 years ago in the United States when the only places that there was electricity were in urban areas. But there's lots of rural areas need electricity too. So we extended technology, we extended electricity, we extended telephone service out into rural areas to allow the benefit to allow that technology and the use of modern technologies out onto the farm, out onto the ranch, out into very small communities, made it possible for producers and consumers to live more efficiently. So we can enhance consumer surplus by providing technologies and distributing technologies, or by eliminating social or political or physical trade barriers. So that's how we do it. Decrease the cost of production. We produce increases in earnings or profits. That's number one, decrease cost of production. Number three, we internalize externalities, what I just described in the graph, which then eliminates the cost-value distortion caused by externalities. So that improves our consumer surplus. And by prudent government and timely government action. For example, vaccinations, which in turn increase healthiness and productivity. Or early childhood screening and periodic testing to screen for disabilities that can be treated to assure that children have the right kind of developmental progress. Or the Women's, Infants, and Children's program that provides supplemental nutrition to pregnant or lactating women and or their infant children to assure a good, healthy, nutritional head start in life. Or Head Start services provided to poor children because we know that they're at a competitive disadvantage in terms of having opportunities either for preschool or early childhood education. And so by government taking action to improve people's well-being, their healthiness, their ability to participate in society, that we enhance productivity or we decrease the level of illness and the costs associated with having an unhealthful life, and we offset that with the benefits of having a more healthy life, being well and being more productive. So that's how we enhance consumer surplus. So here we have our old graph here, but why don't I just draw one for you? And I'm going to just move this graph up, and I'm going to make a new, let me put the document camera on, and I'm going to make a new supply-demand graph. And I just want to describe this very, very simply. And I have a demand curve for something. We're not going to worry about the supply. Here's my demand curve. And we're going to have a system that's in some kind of equilibrium at P, price P. We're producing this quantity, that's a Q, of something. Okay, that's my market. That's what's ever going on. And in my market, I'm producing all of this quantity. And the consumer surplus is represented by this triangular area above. Let's just highlight this really quick. This triangular area above the line P. And this consumer surplus represents the sum of all of the value we are willing to pay for commodity Q in excess of its equilibrium price right here. So some people are willing to pay this amount at this, if only a little bit of this is being produced. There are some people that are willing to pay this price, and if a little more at this next price, a little more is going to be produced. Some people are going to be, and that's our consumer surplus. So what we want to do is we want to enhance consumer surplus by producing or by introducing technologies or making people better off or lowering the costs of production or one way or another making it so that you or so that I can achieve or buy or obtain the things that I need at a lower price, or get more of what I used to buy at the same price. And so how do we do that? Well, we eliminate barriers. Let's say all we're doing is we're improving transportation. And because transportation for receiving this very important commodity, let's imagine there's this place that grows avocados. But you got to drive windy roads and up and down mountains and all over the place. And by the time the avocados get to where people can eat them, they cost a lot because there's just a whole lot of truck involved in that darned avocado. But let's say that where the avocados are grown, if all you needed to do was build this nice big bridge across a river, the avocados could be delivered at a much lower price to a demand area very nearby. Well, if you could do that, you've lowered the price of delivering the avocados, and you've lowered the price that I have to pay for the avocados. And so by lowering the price, you create something called producer surplus. Basically, I have an opportunity to make greater profits because my costs are going down relative to all other avocado producers. And eventually, in a competitive market, that producer surplus gets translated into lower prices for consumers. And if lower prices happen to consumers because I was able to lower the delivered price of avocados, then that means that it's profitable for me to supply now a higher level of avocados, more avocados here at a lower price. So we're selling way more avocados. And we're selling them now at this quantity at this price. Well, what's happened in my economy? I love avocados. And so I am now happier. My well-being has been enhanced. I have been made, my utilities are being maximized because of them putting the darn bridge in there. Why didn't they think of it before? So they put the bridge in there, and because they put the bridge in there, now my consumer surplus has increased. And my consumer surplus has increased by this much. So I've got an enhanced consumer surplus. I've delivered more of something I want at a price, and I'm willing to buy it now, more of them, because the price has gone down, and so the consumer surplus has increased. And because consumer surplus has increased, then my happiness has increased, my value. I'm either getting more avocados, or I'm buying avocados at a lower price, and I have money left over, and I can buy other things that I like. Doesn't matter. The market doesn't care. We're all better off. And if the amount of this increase in consumer surplus exceeds the cost of the bridge over a long period of time, then my regional economy, my society has been made better off because it's now more efficient. We are producing a much more market-efficient commodity than had we had to deliver them the old-fashioned way by a truck going up the mountain and around and coming back down and selling me just a few avocados at the price I want. So that is the very simplest way I can describe a consumer surplus. That's what we're trying to do. By prudent government action, we're trying to lower the delivered price of a commodity or send the right kind of market signal. You're either lowering the delivered price of a commodity, lowering the cost of something like me going to work. Let's say they improve the road. And it used to take me 45 minutes to go to work, but now it only takes me 30 minutes to go to work. Time is money. 15 minutes out of my life has value. 30 minutes both way, a half hour of my day. There's value in that. Plus it lowers my operating costs, and maybe it lowers the wear and tear on my car. And it lowers the cost of delivering goods and services into and out of my community because transportation has been improved. Everybody's welfares are being enhanced. And when consumer surplus reflects an enhancement in our welfare. And if our welfares are enhanced, that's welfare economics. That's the foundation for what we're doing in welfare economics. Let's go back to the computer. Clear as could be. So in this example, this is exactly what I just described. And we're moving from P to P2, and if we move from P to P2 and then down to quantity 2, we've increased our surplus from the area in this A, E, we've added B and D, and we're enhancing our well-being. Okay? So that's what's going on. So we want to enhance consumer surplus. Now, we don't do it just for the heck of it. We need to have a good reason for it. So the government steps in. In welfare economics, there's a role for government to improve the market because the market fails or it disserves us or it underserves us in certain cases. So we get government intervention because it's economically efficient, and when we can demonstrate that the welfare gains are sufficient to offset all the costs. Theoretically, government interventions are justified because it stimulates a Pareto improvement. Now, we get rationales. There's Richard Musgrave and Peggy Musgrave. They were great authors and writers, and they did a lot of research on public finance and welfare economics and urban economics. And anybody who writes urban economics textbooks now still quotes from them, so I've decided I'm just going to quote for them. And they summarize this by saying that the market mechanism alone cannot perform all economic functions. Public policy, the provision of public goods and services, the establishment of legal structures that assure property rights and arbitrate differences, all of those things, those are needed to guide, correct, and supplement the market in certain areas. The market needs help. And even Adam Smith knew that, and most people know that. And in the current, we've had our housing bubble and our correction, and we've had our troubled assets relief program because the banks got themselves in trouble, and we've got all kinds of things going on. And the reason those things are going on currently in the United States is because our market got itself in trouble. The market isn't a self-correcting mechanism. The Austrian School of Economics and Alan Greenspan and many others have admitted, well, the Austrians haven't admitted it, but Alan Greenspan has recently admitted that he got it wrong, that the market isn't self-correcting, that occasionally the market needs help. And so accordingly, and Musgrave conclude, and I like this, the proper size of government is a technical issue rather than an ideological issue. And it's a technical issue insofar as we care about the proper maintenance and management of property rights, of legal structures, and the level of public goods and services has been well defined. That's a technical issue. That's truly a technical issue, not an ideological issue. If you and I can agree that public education is a good thing, if you and I can agree that that it is perhaps unconscionable that there are some people in the United States who have absolutely no access to health care, if that's a general agreement, then it's a technical issue to solve that problem and to demonstrate that society is better off as a consequence of that. It is not an ideological decision. It isn't something. It isn't a supreme battle between capitalism and socialism. It's just simply mathematics. That's all it is. And I agree with that. I agree with that. And unfortunately, many things that can be solved technically, rationally, and prudently, they can't get over the burdens and the hurdles of ideological and political stuff. Still, that's what we're stuck with. This is a political system where, just like in the market where companies compete for my dollar, Pepsi competes with Coke for my sugar fix, politicians compete for my support for ideas. There's a competition of ideas. They call it a marketplace. I don't know that it's a marketplace because there are people who can buy disproportionate amounts of political favor relative to what I can buy or perhaps what you can buy. So I don't want to say there's a market per se. But they're in competition. So let's look at a summary of government intervention in the economy. There are all kinds of things that it can do that improve our economy. In the first case, it can act to assure competitive markets by preventing trust and monopolies that otherwise minimize barriers to competition. It can break up the Standard Oil monopoly. It can break up some of the great big steel monopolies over time. It can, and it did, investigate and find Microsoft guilty of anti-competitive behaviors. and it forced certain remedies. Not too many years ago, we all in the United States got our telephone service from one provider, AT&T. And then that was broken up because it was a monopoly for whom perhaps the original reason for there being a monopoly, a natural monopoly, had disintegrated, had broken up, that there was evidence that there was, because of all of that fixed infrastructure having been deployed, that there was opportunities for competition on the margins, and that the opportunities for competition on the margins would allow for a lower price of telephone service delivered on average. And indeed, long-distance costs, because of competition, went down tremendously in a very short period of time. When I was young, a long-distance call was short. You did not make long-distance calls. By the time my kids were teenagers, my kids made long-distance calls. And this is a little bit before the cell phone insanity. But thankfully, those prices went down. It can act where production is inefficient, like in natural monopolies. We have an inefficient level of production. What we need to produce is an efficient level of production. Now, I want to talk about a natural monopoly. My community providing fresh water is a monopoly. Now, it doesn't have to be but it's a monopoly. The community is best served, whether it's many communities or one area, by having one fresh water supplier, because it costs a lot of money to supply fresh water. You've got to buy all kinds of things to do that and to do it right. And so my society is better off by having one monopoly supplier supplying a maximum amount. So for the most part, we have governments supplying fresh water. And we allow it to not have a profit because we want to produce as much fresh water as possible to make sure we can cover our replacement costs, that it's built into the rate structure, but not have to worry about paying profit to shareholders. A bridge can be a natural monopoly. We could have toll bridges, and we do have toll bridges. But in general, across most of the United States, it's infeasible to collect tolls on bridges. There's not enough traffic. It costs too much money. The collection costs are too high. The values of the bridge, because imposing a collection cost, it's hard to distinguish between somebody whose value of crossing the bridge is high versus someone whose value of crossing the bridge is low. So it's not so good, and so we don't do that. Okay, number 3, a market. A priori needs a government to provide the legal structure to resolve property disputes, protect trade, business secrets, arbitrate disputes. So we need our government. The market needs government to be a referee. Well, I've got checks, by the way, by things that fit into welfare economics as opposed to overall government activity. Number 4, governments provide goods that cannot or will not be provided by the market. Those are the public goods. And that's where the government intervenes or interferes with the economy. It identifies categories of market failure. The market cannot safeguard us. The market cannot provide an adequate amount of health and well-being in certain categories. So the government does that. The government can influence the distribution of incomes and social benefits in a society using its taxing powers and its appropriation powers. Now, here's what it's doing, is promoting something that has something to do with fairness and equity. The market does not care about fairness and equity. The market doesn't care about justice. The market cares about the efficient exchange of goods and services. But fairness and equity are social concerns, political concerns, but they're social concerns. And we have a maldistribution of income. I talked about that way back when we learned about the Robin Hood Index, that some people have a disproportionate share of income because of a variety of things. I said resources. They just happen to found the gold mine. They have natural endowments because they're just smarter than you are or I am. Or dumb luck, one way or the other, or inheritance, or who knows what. But for one reason or another, there's a maldistribution of resources. So we use our taxing powers to redistribute resources. Well, governments can do that. Government can help to promote common economic objectives like full employment and socially desirable rates of job or income growth or economic growth. And so government tries to manage the economy on the margins by minimizing some of the social consequences of not being able to participate in the workforce, or to try to stimulate. Currently, we're in a period where the government is trying to stimulate jobs by investing or spending on lots of capital development. And what they're doing is they're borrowing future productivity, capital development that would have happened in the future for roads and bridges and water systems and flood control, and they're bringing it up into the current sense. So they're bringing that productivity up. Therefore, it's bringing that public spending and the jobs that were required to produce those goods are all going to be in the current sector. Well, that's stimulating. The government's doing that. And then lastly, the government can offset market failures with its taxing power, its regulatory power, and its policy-making power or penalty power. Penalties and fees and fines. Now we're getting into the management of business practices and individual behaviors, but business practices and production practices. And we're making sure that we basically are trying to level the playing field between firms. If you have a firm who's able to externalize costs and other firms aren't, that firm has an unfair advantage. You penalize that firm and you bring their costs more in alignment with everybody else, then they don't have a competitive advantage anymore. You've also remediated, or you're attempting to remediate, the cost that firm has externalized to society. So that's government's intervention in the economy. I'm going to reiterate this. This was in the last component, but we have 4 functions of government. The allocation part, and that's the direct provision of social goods, goods that are non-rival and collectively demanded. Those are our public goods, so that's the primary function of government. We provide most of those goods that we care about at the local level and a little bit at the state level, but most of what I care about I get at the local level. The second is distribution. The government must redistribute resources. I just got done talking about that because that there are unjust distributions of income. And government policy redistributes income and publicly provided goods through tax policy. We use a progressive tax that has a higher rate on richer people because their ability to pay is more, and we have a much lower rate on people of much more modest or low income means because their abilities to pay are less. And so we use indirect. We have service provision and direct income transfers like food stamps and welfare payments, or cost reductions for private goods like housing. We give people housing vouchers, or we provide public housing, or we provide transportation subsidies, or we give them food stamps. So distribution is a role. Stabilization, government needs to stabilize the economy. The economy can fluctuate strongly. Economies always will go into recessions. There is no way to prevent it. It is part of the market cycle. It's part of capitalism. And in the current economy, instability in one country can lead to instability in another. An economic downturn. There are many, many things that we may want to do in an economy. The last president, if the economy wasn't doing good, loved to cut taxes because they said that stimulated consumption, and consumption then sent a signal to producers to produce more, and then that was good for the economy. And so governments try to do different types of things. Sometimes during inflationary times, consumption may need to be curtailed because the economy is expanding too fast and it's too inflationary, and we need to curtail consumption by the federal government raising interest rates, lowering the money supply, slowing down the growth in the economy so that inflation doesn't diminish our well-being over time. There are 3 instruments of stabilization: monetary policy by regulating the money supply, fiscal by using taxes, tax reduction to stimulate consumption, or in the current case, the government is borrowing money to stimulate activity, and it's doing that by paying for public works. The third one, by financing public projects to attain the twin goals of public service provision. Roads are good, Flood control is good, as well as stimulating private and industrial consumption of market and non-market goods. And then the last one I had said before was housekeeping and administration. We just need someone to keep track of the books and to be the referee and to maintain the public's resources appropriately. That's going to be the end of this session, and what we're going to move on to next is actual discussion of what are benefits and what are costs, and then moving into some exercises to help us figure out what benefits and costs are, what they aren't, how do we calculate them, how do we discern between option A versus option B versus option C versus option D? How might our choices be made given a certain set of constraints or political considerations? How might we think in terms of averaging benefits versus producing discrete sets of benefits? There are all kinds of things that I want to move into next, and we're going to work our way through in the next set of lectures. I think this has now provided us with a very, very good foundation. We've gotten ourselves through the origins of benefit cost, the history. We've gotten ourselves through in just 2 lectures, welfare economics and the roles and the responsibilities of government to improve our well-being, actually to improve our market by government intervention. And now we're going to move on to benefit and cost considerations into the next lecture. Look forward to seeing you then.